Our trade management is a critical part of our overall trading success, but it's even more important to do it properly. Just like when placing a stop loss, we have to understand that the market is dynamic and not static. Therefore, we need to develop a dynamic way to manage our trades. Setting a specific swing size to move your stop is just not a sound strategy, and it's going to cause you to take more break-even trades than you really need to. This is going to cut into your profits and can be really extremely frustrating. Just think about it. When you have your trade on, you've done all the analysis, you have a good trade, trade starts to move in your direction, you go ahead and you take the risk out of the trade, make it a break-even trade, or get free, as some folks like to say. And then the market pulls back, takes out your stop for break-even, and then continues on to your target. Now, there's going to be times when this happens anyway, but you can cut down on the times this happens by using key levels to protect your stop losses. All right, volatility changes, so your trade management needs to account for that fact. Move your stop to a point where the trade pattern would be invalidated. Otherwise, a simple pullback can stop out your trade only to continue to the target without you. And this is when things can get frustrating. And as we talked about earlier, it's when Peter would say you're standing on one leg and kicking yourself with the other. Just like with placing our stop loss, we understand the market swings change. One day may have a 50 pip average daily range. The next day the next week might have a 150 pip average daily range. All right, so our trade management has to be able to account for that. You don't want to say, I'm just going to get 20 pips up in a trade and reduce the risk or take the risk out of the trade completely. That type of a strategy does not take into account the volatility of the market, the changes in the market, and it's just not very effective. Use key levels to protect your stop loss. Swing points, Fibonacci levels. If break-even is a few pips away from a swing point, who cares? Use the swing point to protect your stop. Don't become loss averse and let a few pips change how you manage your positions. Just think about it. And as long as you're not using too much leverage. If you're using the proper amounts of leverage, a 0.05% or a 0.1% loss is still a break-even trade. It's basically still a break-even trade. Okay, but for some reason, a lot of traders allow the market to play mind games with them over even the smallest of losses. Now, our objective divergence strategy, again, has a very objective way to manage the trade. Other trades that we take are going to be not quite as objective. They're going to require a bit more thought. We're going to look for levels, for key levels. We're going to look at the patterns and see where the pattern would be disqualified. We can look for things such as extensions in the other direction. If we see an extension in the other direction, obviously we probably want to go ahead and get out of the trade. Okay, so there's going to be some flexibility to how we manage the trades, but it's important that we use key swing points, okay, use the patterns that we're looking at in the market where the patterns will be invalidated, because that's what's going to stop you from getting stopped out by just these normal, swings of the market, the normal ebb and flow of the market. Okay, the market doesn't move in a straight line. There's going to be progression, there's going to be correction, there's going to be progression, there's going to be correction. And the dynamics of that will change from day to day and week to week. All right, so our trade management has to be able to reflect that as well.